All right, guys, this is being recorded. I mentioned it at the beginning of every webinar, you guys. Watch this again. Maybe not just this long put webinar, but one of the other ones that I've done also, because you guys drive the content. You may have questions that somebody else didn't have, and there might be those questions still in your mind that somebody else asked in a different question. So you guys really drive the content and really make this work. So you might want to check out one of those other ones. The reason why I say watch it again is because it puts it into your long-term memory. If you just watch this once, you're going to be like, what was that strike location, or why was the volatility important? Stuff like that will make this sink into your long-term memory, and you probably understand it a little bit better, especially if you're a newer trader. If you're an old sea dog like me, well, you know, it's hard to break some of those old habits, and this watching it again will help you remember some of these rules that I've come up with. It's not really rules that you necessarily have to do, but they're guidelines to follow in order to increase your probabilities of success. And I'll talk about how the way that I set up every strategy increases your probability of success, because we're implementing this in an environment that is conducive for this specific underlying and this strategy. North Georgia. Hello, Pedro, sorry. All right, so let's get started here. This is going to be on the long put. It's roadmap. So what I've done in the past is talked about the specific strategy. Well, what I like to do here is come up with an underlying and a directional assumption and find out all of the things around that underlying. That will tell us what the right strategy is. So yes, I have kind of picked out or kind of already looked at a specific underlying that will fit this strategy, but ultimately that's not how we come up with it. We don't go, well, I'm going to implement a long put today. Sometimes you might, because you want to add some negative deltas to an overall long portfolio, which I highly recommend. We don't want to always be completely one directional. We need to have some other things in our portfolio in order to increase that hedge, if you will. So this is a great one for something like that. And yes, there is always a bull market and there's always a bear market. There's always somebody that's going to be suffering, and especially in today's environment, we can always find somebody that's going to hurt. All right. So yeah, Pedro is saying American Airlines. What's going on with American? I'm falling on my first. I'm failing on my first weekly option. I didn't look at American Airlines right now. I covered all travel and leisure that I had in my portfolio. So I, to be honest, haven't really looked at it, but we could probably look at it for this strategy if you are bearish. All right, so just remind me of that a little bit down the road. So we're going to kind of try and forget about the fact that we're looking at the long put, all right? So let me get a couple of things out of the way real quick, though. My name is Eric Wilkinson. You guys might recognize me from mainstream media, where I've talked about everything from economic to geopolitical and market analysis. I've been trading my own money for about 25 years now, which I started trading in college with a psychology degree and decided, you know what, I kind of like this trading thing, switched it over to finance and moved to Chicago to work on the floor of the Board of Trade. But I still say almost to this day that my psychology degree probably helps me with my trading on a daily basis as much, if not more, than my financial degree. Sometimes when we get a real idea in our head, we want to stick with it. Well, that psychology part of it, there's always like that gut instinct that'll tell us the right direction. And that's what I'd rather go with than trying to talk myself into believing what my analysis is always true. So keep that in mind as well. So in that time, I've traded everything from stocks to financial futures, commodity futures, currencies, and options on all these products in just about all market conditions. If you guys have been trading through all this, you've probably been trading through one of the craziest times as well, though. You can follow me on Twitter at Wolfman's blog, or our parent company is at ProTraderStrat for all kinds of snark from me and market wisdom from ProTraderStrat. Also, our Facebook page. That has a lot of content we're pushing out there, a lot of my daily market commentaries where I talk about all my trades, when and where I put those on, the wins, the loses, and the draws. So I probably talk about my losses or my losers more than my winners, because those winners come and go really quickly, whereas those losers we're trying to stay mechanical and turn those trades around into a positive P&L there. So follow us on Facebook for that. So again, we are doing this long put, but I want you to forget about that for a moment. We're going to find our way to the long put eventually. But I want to figure out, when we're looking at a roadmap, right, we have that little key down there, that little insert that tells us, where the roads are, what type of roads it is, where the intersections are that we can get on and off of different interstates. So we need to know what the key is telling us in order to be successful. And that's the same thing that goes with trading options. So with that being said, delta, and I've got our little roadmap key here. Delta is the effect of the option premium in relation to the underlying. So what does that mean, really? Let's get to the nitty gritty here. Let me find my trading platform real quick, and we'll pull that up. I'll pull up this one. Excuse me for not having this all ready for you guys. So let's go over to, all right, pull this over. All right, so delta right here. Delta tells us what the change in our strike price is going to be. So these are the prices of the strikes of the call and the puts, all right? So we can look at either one of them. Delta is negative on the puts. Why? Because the assumption on that definition I just gave you is on the assumption of a $1 move higher. So if we're always thinking about it in a dollar move higher, then that makes delta negative in this case. So that goes for all of the Greeks, and that's what we're kind of going over in our little roadmap key here. Is first one is delta. So what this is telling us is that for the first dollar move in delta, or this, let me get my pen out here. All right, so we've got delta, and it's 31.75. So when this moves to $32.75, okay, so that is $1 move higher, $1 move to the upside. So it's an increase of $1. What happens to all of our premiums is the correlating delta increases by that amount. So if we're looking at just out of the money calls, in this case, we're going to say that a dollar increase, this 57 cents goes into those premiums. So it basically goes from $4.70 on the bid to $4.27, right? Because that's 57 increase, right? So then we've got $5. Let me erase that. $5 goes to $5.27. Right, on the bid. Now the offer then increases by that 57 cents also, all other things being equal, you guys, and that goes to $6 then, $6.47. So that's kind of what the market would look like with that first dollar increase, all right? Now on the put side, it's a negative, right? So we've got a plus $1 increase. Well, this is a negative, so that means that these prices would decrease. So our puts would then go to $4.10 on that same dollar increase, and $4.30. That's kind of how those markets would end up looking if we've got $1 increase, okay? Vice versa, if it's a negative, if it goes down by $1, then a negative plus a positive would make that delta a negative, right? So it would subtract from our premiums. And the same of if it was a negative $1, then a negative plus a negative, that would make this delta a positive then, right? So same math kind of principles going on there. A negative plus a negative makes it a positive. So if we came down by $1, then the put premiums would actually increase, okay? Pretty basic stuff so far. Then we go over to what we are, our next Greek, which is going to be gamma. Now, gamma is the rate of change to delta. So this tells us what happens to our premiums on the second dollar increase. So if I can pull back up my platform again, and we'll take a look at what the gamma is on these. Let's pull up the pen. There we go. So we said that the increase on the first dollar, let's just go over that again. On the first dollar increase, and that means that our stock is now trading $32.75, right? That increased these premiums from $4.70 on the bid to $5.27, and then, $5.27, and then $5.47. Okay, so they increased by that on the first dollar. Now on the second dollar, we've got gamma. Now the easiest thing to remember these two Greeks, delta tells us data. It's got all kinds of data. It's probabilities and everything else that I'm not going to go in and muddy the waters right now. I have videos on it and everything. So delta is data. Gamma just goes with delta. All right, so gamma goes with delta on the second dollar. So on dollar number 2, gamma goes into the delta. So now we're looking at trading at around $33.75. Okay, so the underlying has moved up by $2. Now our premium, we've got gamma going with delta. The next dollar, those same premiums will increase by 60 cents. All right, so now on that second dollar move higher, we're going to be looking at $5.87, right? And then on this one, it's going to be $6.07. All right, so they both increased by 60 cents, all right, on the bid and offer. And that's all else things being equal. Yes, they could change by a couple of pennies here and there, depending on, free market price discovery. But in theory, that is the idea. Same with over there in gamma. The gamma, a negative plus a positive on that second dollar move higher. This gamma would only on the second dollar move by 37 cents, okay? Because gamma is positive. We've got a negative delta. We've got a move higher. So now that second dollar move higher, our premiums will only decrease by 37 cents, okay? Does that make sense so far? And vice versa. If it was a negative move, a negative plus that negative delta makes it a positive delta on a $2 move lower, then gamma adds into that delta for the puts. All right, so it works pretty much the same there. Any questions so far? Delta is data. Gamma just goes with delta. Just get my pen ready for this. I'm going to do ink color. There we go. All right. Now, theta. Theta is the impact of time on our premium. All right. We used to call theta the thief in the night because theta is always eating away at our premiums. It never stops until expiration. After expiration, then they're all gone, right? But theta, during the life of this option contract, it's coming and eating away at our premium. All right. So theta is the thief in the night. And theta actually picks up momentum as we get closer and closer to expiration. Theta starts really ramping up its erosion of those premiums. So we can take a look at this again. Theta right here is always negative on the puts and the calls because tomorrow we don't have a DeLorean that takes us back in time. So tomorrow, these premiums will all decrease, all other things being equal, right? There's no change in the price of the underlying, but just one day goes by. We can assume that all of our premiums will decrease by that theta. And we can see that if we go out 200 plus days, we can see theta is only 2 versus inside here 4. And we've got a monthly that we can take a look at. We can take a look at these and look at this theta has really picked up some momentum, right? So the closer to expiration, theta gets really aggressive. All right. He knows you're going to move and he's got to steal everything out of your house before he leaves or something. I don't know. So he's the thief in the night that comes and steals your premium. And if nothing else changes, that's what theta does to your premiums. All right. So theta is the thief. And then we have the one and only dude that's not really a Greek, and that's Vega. I don't know why they picked Vega as this, but other than the fact that it starts with a V and it's correlated to volatility. Yes, I do have a Greek letter over here. That's actually the lowercase gamma. I just stole it because it looks like a V. But Vega measures the rate of or measures the change in volatility. So basically what Vega does is for every, we're assuming an increase again. So when we talk about increases in Vega, it's 1 percentage point. So when we're taking a look back at our platform, we're talking about Vega over here, and I don't want to do 1 day. We can take a look at Vega over here. Vega is this line, all right? So we can see it's 81.83. So when it goes to 82.83, basically all of the premiums will increase by the corresponding Vega. So 1 percentage point increase, 5 cents goes into our premiums, all right? So Vega can help us and Vega can hurt us. So we want to take advantage of volatility because it can be one of the things that really makes or breaks any option strategy, you guys. Not enough people talk about it. You know, when people are going out there online and they're talking about buying calls ahead of an earnings, that's like one of the worst things to do, all right? Because you can be directionally right when that volatility crushes, because think about it. When you're going into a binary event, which is just like an earnings or an FOMC for the bonds, you go into that binary event, well, people are nervous, people are afraid, people are putting on protection, volatility is spiking, all right? After that earnings event, everything, the veil's lifted off, right? We know everything about what's been going on. There's no more volatility. There's no more necessarily fear going on. So volatility has a tendency to really fall out of bed. I mean, a lot. So, you know, you could see 20 percentage points come out of this underlying right here. So, you know, you decrease by 20 percentage points. We're talking 10 percentage points is 50 cents, a dollar at least coming out of our premiums, right? Well, if it only went up by $2, that would completely offset our directional move in Delta, right? Delta had a $2 move and we're still less than a dollar increase. So that's some of the impact of how volatility is going to affect your premiums. So you got to make sure that you take advantage of that. And I think I just misspoke there for a second. I talked about a $2 increase. That would really hurt our underlying. But $2 decrease is what I should have said on the put side. $2 decrease and 20 percentage points coming out of our volatility. Therefore, we would lose a dollar in Vega and we would only gain in value about 83 cents, right? Because that we got to add that delta in for the first dollar move is 40 cents. The second dollar move, gamma goes with delta, that's 43 cents. So all in 83 cents coming into our premiums, but we lost a dollar in Vega. So that would hurt us. So make sure when you're implementing these strategies, that's why I'm setting us up for why we are going to do what we're going to do with this specific strategy. Okay, so but we need to know how those things are going to impact our premiums. All right, so let's start out with our road trip. Now that we've got our key all figured out, we're going on a road trip, let's say, and the idea here is I'm looking at a specific underlying, all right? And my thesis on this, let's just throw out a thesis to come up with something, and it's not necessarily what we're going to do here, but it's possible, right? So what we have is this pandemic going on, and I'm thinking we're seeing transportation. People are not going on buses and not going on trains and stuff like that. We're even seeing people go out there and buy cars and RVs because they don't want to go into an airplane and travel like that. They want to travel on their own and pick their own destinations, if they will, and or who's going to be in their cars. Well, that leads me to believe that ride sharing could start going down. If people are going out and buying these cars, that means those people that were saying, I'm not going to own a car because I'm just going to do ride sharing now. Well, I think that those people are a lot of the ones that are going out and buying cars right now. So I'm not even talking just new cars. Used cars sales are going through the roof right now. So my thesis is these ride sharings are going to struggle going forward. And you got Uber and Lyft are the big ones. And who's going to ride one of those scooters right now, right? You want to go out there and just grab a scooter somebody dropped off? So that's going to hurt them as well. But so I'm looking at Lyft. I think Uber's got a little bit more diversification with some of the deliveries and stuff like that. They're also the big name in the space. So I think Lyft stock price is probably going to be hurt the most. So I've got a bearish assumption in Lyft. So let's just say we're starting out here in Chicago just because it seems like there's a lot of roads coming out of it. And we're going to go to, what did I say? Lyft. We're going to go to Lyft. We're going to say this is Lyft. All right. So I have a bearish assumption. I'm not going to take the upward road. I'm going to head this way. I'm going to head south, right? So, you know, I've got my directional assumption. I have a bearish directional assumption. I'm thinking we are going to head south in order to get to Lyft, all right? So I've got my underlying, I'm bearish in it. I've got my assumption. So I'm going to, like I said, head out of Chicago, and I'm going to head this way to Lyft, all right? Now, another thing we have to understand is, you know, Lyft, is there anything going on? I mean, if Lyft was right here, is there anything going on in Lyft? I'm picking this one because it seems like there's a lot going on. If there's nothing going on in Lyft, I might just bypass it and go all the way out to Uber, okay? So, because I've got a directional assumption in that space, right? So I have to understand, is Lyft right here or is Lyft right here, right? So we have to understand, do we have a good destination? Is there anything going on there? Is it a one-horse town? So I need to find out if there's a lot going on in Lyft. So way to do that is we go over to the option montage, and this is the option montage page. So if you ever hear me saying the option montage, this is what I'm referring to, this page, because it has everything going on in it, all right? So what we have to do is understand whether or not this is an underlying that has a lot going on. Is there a lot of eyeballs there? Is there a lot of open interest, a lot of interesting things to do in Lyft? Well, what we do here is we look at the underlying. So the underlying here, I can already see this is getting a little wanky. I'll pull this up though. I took a screenshot of Lyft right before the close, because what happens after the close? All our orders get canceled, right? And when those orders are getting canceled, it's free market price discovery is no longer going on. Those bid offers get really wide. So what my rule here is this is an underlying that is trading less than $100, all right? So if XYZ is trading less than $100, it's the $100 stock, all right? Less than $100 stock. We need the option montage, which this is, the option montage on these just out of the money or just at the money calls and puts, closest expiration. Now, I know we've got 1 day to go in the other option, monthly expiration, but in the monthlies that are closest to expiration, or the spot month is what we used to call it on the floor, that's the one that is right around 35 days to expiration. That's where people start rolling out of that front month that might only have 5 days to go, right? Rolling out of that month and into the 35 days to expiration. So this is where most of the volume and open interest is going on. This is where the eyeballs are going on. This is how we can determine whether there's a lot of volume and open interest. You can already see there's a lot of open interest, a lot of volume going on in here. So that's kind of one key. And yes, you can look at volume and open interest to determine, but this is a shortcut. This is where you can immediately look over. You don't even have to change away from the delta gamma montage. You can immediately look at this rule and say, all right, it's less than $100 stock. I need the bid offers to be less than or equal to 10 cents wide. Everybody see that okay? I think that's showing up pretty good. So we can see here that these strikes are well within that parameter. All right. We can see on both sides, the calls and the puts, and even some of the in the monies are fitting that rule, less than or equal to 10 cents wide. Now, since we're talking about a roadmap here, you know, I have some rules, and I probably should have written that in a different color. Probably should have written this if it falls within this rule of being less than or equal to 10 cents there. That basically gives us a green light. All right. So we can see that this is a green light there. Now, if it is 2 times my rule, basically 2 times the rule, that's a yellow light. So this needs, you know, if you're a newer option trader, then I'd start veering away from this, especially on the ones that are less than $100, because it's starting to tell you there's not a lot of eyeballs on there. You're going to have to determine price. There might be only one cat in town where he's the one making the markets, and he's like, you know what, you got to come to me. I'm not going to trade with you. You got to basically hit my bid or lift my offer because I know I'm making the markets. All right. So we want to stay away from that. We want to get into something where free market price discovery is going on quite rapidly. Whereas if I'm coming in here to buy these puts, you know, and I basically change the bid and I come in, I'm 258 cent bid. Well, this offer might come down and say, you know what? All right, I'll be at, 259, something like that. So, you know, we can meet in the middle kind of thing. So that's what we want to be having happen, where we get people stepping over each other to try and better the markets. That's free market price discovery in full swing. And basically, you know, if it's anything outside of 2 times that rule, like 3 times the rule, I would say walk away. All right. Find another underlying. So if Lyft wasn't fitting this rule, I would say there's nothing going on in Lyft. I'm going to go to Uber and see what's going on there, because in that space, I still have this bearish directional assumption, right? I want to take a bearish road to it. All right. So I would have to go through these same steps in order to determine what strategy, what bearish strategy I would put on, and then Uber or something. But Lyft, we can see, is following this rule. After the close, all our orders get canceled. So you can see they get a little bit wider. So when you're going through this process, make sure it's during open market operations to make sure that it's fitting this rule. So we know that our destination is pretty good, right? We know that there is a lot of things going on in Lyft. It's a big city. People are playing it. So Lyft, you know, works out. So we're going to head to that southern route to Lyft. We are going to probably put a strategy on around this because it's got tight markets. Now, we have to figure out what the environment is. What is the environment? What's going to affect us going to Lyft on our way out there? And one way to kind of think about it is, if it's sunny, the roads are clear, you know, you got clear visibility, there's low volatility, right? We can look at like rain and thunderstorms and sleet and stuff like that as high volatility. The pressure's up, right? So if it was high volatility, you know, I might want to beeline it there, you know, get there, take the shortest road, get there as fast as I can. But when it's sunny, you know, when it's sunny out there and I'm heading over here to Lyft, we could say, you know what, I'm going to head out of here. I'm going to hit some of the destinations. I'm going to go through Springfield. I'm going to head south through Little Rock. Check that out. You know, when you're coming across Texas, if you've ever taken this Route 40, you go through Amarillo, which is, this, believe it or not, this northern part of Texas, a lot of people don't go there, but it's got some pretty cool stuff. They got the Big Texan. I don't know if you've heard of that. It's got the 72-ounce steak. So if you got a big appetite and been on the road for a long time, you want to try and eat a 72-ounce steak. If you do eat the 72-ounce steak, which looks like a human lung, it's so huge, and this baked potato that's about this big, and a piece of Texas toast and a salad and I think shrimp cocktail. If you eat that entire meal, you get it for free. But if you don't eat it, you got to pay for it. So Amarillo's got the Big Texan, pretty cool place to check out. And then just outside of that, it's called the Cadillac Ranch. Cadillac Ranch is basically where this guy's taken like the 50s era Cadillacs and literally stuck them in the ground, and you could go out there and spray paint on them. I think I have a picture somewhere on social media where I spray painted on the Cadillac. And then you can head out. So you're heading out west. You might take a diversion, take a long time to get out there, go through Taos, something like that, right? So you can take some of the offshoots and see some of the sights as you're going out there. So it's going to take you a longer duration. So we want to take that longer duration time to get there is kind of what I'm getting at. So in this case, when we're looking at, lift, we need to look and see where implied volatility is for it. And you can see that lift's implied volatility is relatively low to where it's been in the past. As a matter of fact, what we're going to look at here is implied volatility percent, which I have it over here on the side somewhere if I could find it. If I could find lift, there it is. It's an IV percent of 15. We're not talking about, this says implied volatility, right? And I'm talking implied volatility, but what I'm saying now is implied, and this is a percent. So it can be a little confusing. But the problem with just looking at implied volatility, that a 73 doesn't tell me anything really about lift's premiums. And that's what we're trying to get at here with the volatility, all right? Volatility pumps up premiums, right? So when volatility for lift is really high, then we know that those premiums are the most expensive we've seen. And then when volatility is really low for lift, then we know that those premiums are super cheap, right? So we want to buy cheap, we want to buy low volatility, we want to sell high volatility is the idea there. Because what happens is volatility, when it gets really low, it starts ramping back up. It wants to go back to the median, right in the middle. All right. When it spikes really high, it'll want to drag back down. Now, I'm not saying that when it's at its extreme high, it can't go even more extreme high, right? Or when it's at extreme low, it can't go any lower. Yes, it can. But all we can do is kind of pick, just kind of like a stock wants to usually stay within a range or a pattern in a sense. When it spikes out, you start seeing it want to trickle back down and pull back a little bit. Same thing happens with volatility. You get the spikes, it wants to pull back, it falls down, it wants to come back. All right. So it wants to usually stay within a pretty decent range. Yes, we've just seen some unprecedented moves in the markets, and that's kind of drawn implied volatility in all kinds of wanky ways. But all we can say is when we see low volatility for itself, that's the time to buy. All right. And how we figure that out is, I'm just going to do it on this one here. How we figure implied volatility out is to go and look at where the underlying is now. So the ultimate thing to do here is look at implied volatility. So IV percent now, this is what I'm talking about. That's what's over here in this column here. That's what's telling me this. We take where it is currently. We can see it's 79. This isn't going to be a very good example. 79. So we take the current IV minus the low IV. All right. We take that sum and divide it by the high IV minus the low IV. All right. So what it really does is it tells us, and you know, some of you math guys can tell right now, can see why this is, you know, something that if I was at 100% IV, it would tell me that it's at its highest, right? Well, yeah, but if volatility ticks up a little bit higher, it goes from, let's say, 90 to 95. Well, if my previous fraction here had 95 or 90 here, and it moved up to 95, well, it would still give me 100%, all right? And same as the low. If it goes lower than where the previous low was, it's still going to say it was at 0. And that is a bit of a flaw in this math equation. But, you know, you can see that when it went really low, yes, it may have gone lower in one of those spots from where it was previous here, but it doesn't go too much further out of that. And, you know, obviously, this is a factor that we've been living with. I think that we're going to start continuing to see some of this higher volatility going forward as we kind of work ourselves through this whole pandemic, going through the summer and everything else. So I think volatility is here to stay, at least for the foreseeable future. So in this case, what we would do is, and somebody's probably going to have to pull out a calculator for me. So we're going to have to go where the current here is. Let's just call it 74. I'm going to round. You know, you can do a decimal there. 74, the low looks like it was, let's call it 40. So 74 minus 40, we're going to take that sum and divide it by the high, which was somewhere around 2.5. That's a point. So 2.5 minus that 0.4, right? So basically in the upside, we've got 0.24, and in the lower end, we've got 2.1, right? So in that case, if we were to divide those two by each other, that's going to come out, well, mine's a little bit off. We can see it goes 210 goes into 240 one time, and then almost 2 times there. So with mine, it's coming up with a round, we're going to call it around 12. We can see over here, if we punched in the exact numbers, we would come up with a 15. You know, yes, it's a decimal, but when you put it into percentages, right, you do that. Right, so 12%, or in this case, I'm going to go with the math on that because I'm pretty sure they're right. All right, so that's how we come up with implied volatility percent. And we need to know that because that tells us right now these premiums are pretty cheap, which in that case, that means we want to be thinking probably closer to a buy, right? We're looking at something that we might be wanting to buy. We've got low volatility. We can take our time in a sense. This will all come back together in a minute. Why does volatility matter? I think I mentioned this a little bit. As volatility, Pedro, I see your question. As volatility increases, those premiums increase. That's why implied volatility, we want to buy IV percent when it's down here because we know implied volatility is low, right? And what I mean by 12% is it means it's like in the lowest, you know, it's almost at the lowest 1 out of 10, you know, it's the lowest 10, it's only 10% area, you know, that means it's pretty cheap. Anything below 50, you're thinking kind of buy. Anything above 50, that means those premiums are getting pretty expensive. That means you would want to sell it. So yes, you want to buy low volatility because you expect it to go higher. All right. You know, and vice versa. If volatility was really high, you know that these are really expensive premiums. And then in that case, you would expect them to go down is the idea. So right now, you know, we're kind of like our implied volatility percent is somewhere around here, right? So we're kind of thinking volatility is going to start moving up, or at least, we don't necessarily know that it is going to, but we know that if we're buying it so cheap that volatility, remember we talked about volatility, at 1 percentage point change can affect our premiums. Well, we know it doesn't have a whole lot of room to go down at this point, but it's got a whole lot of room to go up if it starts moving. So we're just trying to set ourselves up for success, right? We wouldn't want to be buying premiums when they're super expensive up here. We want to stay away from that. We want to try and get it when they're super cheap. It doesn't always make it, it doesn't always work out. Sometimes volatility will trickle off and we can't do anything about that necessarily, but it doesn't have a whole lot of room to go down at this point is what we're kind of looking at. Does that make sense? Cool. I think that means okay. Or you're typing. All right. So here we go. Volatility. We know volatility affects the price of an option, right? For every 1 percentage point increase, that premium increases by the corresponding implied Vega, right? So in that case, if we buy volatility, implied volatility really low, and we expect that to rise up. I'll give you another example here in a second. If implied volatility is really low, we want to buy it because we expect it to march back to the median, all right? When it's really high, we expect it to come off and move back to the median in a sense. So this looks like a regular chart, like of any stock that we have. Well, we have implied volatility here. But with this implied volatility, what we're looking at is, you can see it stays within a certain range again. 65 is the high here. And, it's currently at 52. And we could say that the low right here, we could even march out some of these lows, like maybe it usually only gets down to 25, right? So we could do the same math again on this particular one. And what do we have? The current implied volatility. So the current IV minus the low IV, and take that sum and divide it by the high IV minus the low IV. Right, that's our equation. So right now we have the current IV is 52 minus the low IV, which is 25. And we take that sum and divide it by the high IV, which is 65, minus the 25, right? We good there so far? So we've got 17, right? 17 divided by 40. So 40 goes in there, 40 goes into 170 4 times, right? So 4, and we've got 100 left over, so it goes in 2 times, so about it's got to be higher than 42 percentile. I need my math. Somebody do the math. Is that 42%? Seems a little low. It seems way low. Is that math right? All right, 42%. Let me just do it again. So we got the high. You know why it looks a little low. All right, so we've got the current implied volatility, which is 52 minus 25. That gives me, that's why I did that wrong. So that's 27. That's why I did the math wrong, because it's 27. So the current IV is 52, right? So 52 minus the low, which is 25. I did the math wrong there. That equals 17. I said 27. 17, it's 27. So that's why I threw off the math. And then we've got 65 as the high minus the low, which is, we said 25, right? So 27 over 40 is what we're looking at there. So we want 27 over 40. Thank you, Ed, all over. Ed Dalton, thank you. So it's 60. So it's at the 60 percentile. Just a calculation. Yes, Banu coming to my savior. She knows it's late in the day. I have trouble. So 27 over 40. So 67 percentile. That's why it seemed a little bit low for that. So it's in the 67 percentile. It's in the upper band there. So that in that case, we've got some high volatility. But something also to note with this, you can see how volatility, you know, when it spikes, it has a tendency to work itself back, just like what we see on charts and stuff like that. In this case, volatility starting to ramp back up. All right, this underlying. It doesn't matter what underlying. I'm just trying to give you guys the example of what that looks like. So now we've talked about some of these different things, right? We know what delta does on the dollar difference, the gamma. So now we're really going to start focusing in on volatility, how that affects us. We know on our particular underlying lift, there's a lot going on in lift, and therefore we've got low volatility. So that means we can take our time meandering around, right? Which means we're kind of taking a long time to get there. We've got low volatility, which means we're going to be kind of buying. Remember I talked about theta? If we're thinking about we need to buy low volatility, and theta is the thief in the night that steals my premiums, what do I want to do? We want to get out in time where theta isn't really being very aggressive, right? Now, if I sold it, if I sold these premiums and I was shorting something, then I would want volatility to be high, expect that volatility to work down, those premiums go down, that helps me. I'd also want to take advantage of that thief in the night that comes and steals my premiums, right? Well, in this case, we've got low volatility. I know I'm buying cheap. And so if I want to buy something, I don't want it to erode very quickly, right? So if the thief doesn't steal my premiums way on time, you know that we're looking at a longer duration. So in that case, we're going to be kind of, you know, taking the long road. We're going to be hitting all these different things. We're going to stop and, you know, spend an hour at the Big Texan. Actually, you can spend a couple hours at the Big Texan. You can also go and see the ball of yarn. Actually, the ball of yarn's over in Iowa. But, you know, you get my drift. You can go and see those different crazy roadside attractions that I'm a sucker for. I've hit just about every one of them off of 40, off of 70, off of 90. I've hit just about every roadside attractions that you'd ever hear of. So in this case, you know, I'm going to take the long road, maybe go to the Four Corners, go and see Antelope Canyon, which is something, you know, everybody should do. It's, you know, everybody goes to the Grand Canyon. Well, Antelope Canyon, I will assure you, you will not be disappointed. And then kind of head back out to, and there's also a really good custard place out there in the middle of nowhere as you're traveling out west that way. You can get prickly pear custard, which is, I don't know if you'll find it anywhere else. Anyway, you know, so we can take that long road, long destination. We want a long expiration, right? So we want to limit that theta decay. So we're going to be buying an option. Trader wants to limit that theta decay. Why? Because we talked about this earlier, right? Look what our premiums look what happens to our premiums really close. 35 days to expiration. We're right inside of that, right? So right now, that thief in the night, 35 days to expiration to about 7 days to expiration, that's where we see 50% in premiums get eroded. That's basically if the underlying didn't move, just the premiums from theta decay contracting. All right. So in this case, we want to get out here, right? We can see that we can't get rid of him. We can't get rid of him. Sometimes we can offset him, but we can't. You can't always get rid of it. So in this case, we want to get out here in time. You know, 70-ish days to expiration is really what we're going to be looking at. Anything outside of basically 50 days is what I really look at. I'm not saying I want to be in this strategy for 70 days, right? You know, when we're looking at chart setups and stuff like that, and we come up with our assumption, we're not looking at it for like maybe 3 years or something like that. I'm not looking to ride lift to zero. I don't know if that's going to happen, especially, you know, the government's going out there and supporting a lot of these companies that are having trouble. You know, I don't know that it's going to go to zero. So in that case, I usually play these things off of my assumption for a quick move. And, you know, if I start getting that move, then I'm happy. But I'm not trying to ride these things into the dirt. So we've talked, let's go over this. What vehicle do we use? Well, we're going to use the long put, right? We're kind of leaning towards that, right? Because we came up with the idea that if we are buying low premium, that means we're kind of buying an option, right? That means it's a long, and we have a bearish assumption. Well, a put is a bearish assumption. Low volatility, all of those things leads us to the long put. Yes, you could do like a synthetic short and stuff like that. But in this case, I've got really low implied volatility. I think volatility is going to start spiking in and around this underlying. I want to take advantage of those things. I'm looking at the long put in this case. So what spots do we visit? Well, in the long put, our spots to visit are the strike locations in this case. So we're going to be trying to look at buying the 45 or 35 delta. Now, if you're a little bit more bearish, like you think this is going to happen relatively quickly, well, then I might look at some of that 35 delta. You know, you can get a little bit further away. I usually look at it with the premiums and stuff like that. You know, if you're looking at over $100 stock, which I forgot to mention on our picking the right underlying, and I'll do that here in a second. But if the premium, you know, on $100 stock around, you know, the 45 delta, I might lean towards the 35 delta just so I don't have to lay out as much cash. I'm cheap that way. So I might do that as well. So give or take 35, 45 delta, that to me doesn't really matter. I look at delta. Remember I said it was data is the probabilities of success here. And if I do a 35 delta, that means there's only about a 35% chance of my strike being in the money at expiration. Now, 2 times the delta is the probability of the market coming down and hitting my strike, okay? So that's the probabilities I'm usually looking for, especially if like the 35 delta or something like that. I've beaten the probabilities. You know, I have a 70% chance of the market coming down and hitting my strike, but only a 35% chance of my strike being in the money at expiration. Well, those probabilities of it coming down and hitting me are much better. I'm usually looking at quick hits. Same goes for the 45 delta, 45% chance of being in the money at expiration, but an 80% chance, or sorry, a 90% chance of the market coming down and touching my strike. So we're going to be picking just out of the money ones. I don't necessarily like picking the in the money ones. For one, I said I was cheap, right? And 2, there's extrinsic and intrinsic value of those options in the money that I could lose. So why lose the, if I'm directionally wrong, why lose the intrinsic value, which is what that option is worth? It's just more expensive. All right, so the direction. We've kind of talked about this, and our destination. When we're picking the direction, we've got that directional move. Our destination, XYZ. Remember, this had to do with the eyeballs, you know. Are there a lot of eyeballs going, you know, we have a lot of people watching it? Well, remember this rule was if it is, you know, less than $100 stock, if it's less than $100 stock, it needs to be less than or equal to 10 cents, right? Well, I forgot to mention, if it's greater than $100 stock, if it's over $100 stock, let's just say, you know, the stock is $235. Well, for this rule, we move the decimal 3 ticks to the left. So like then my rule would be 24 cents, all right? So it needs to be less than or equal to 24 cents. Does that make sense? For the destination, right? That's my green light for greater than $100 stock. 2 times the rule is a yellow light. Red light's 3 times the rule. All right. So in this case, over $100 stock, move the decimal 3 ticks to the left. 24 cents would be the green light rule. All right. So 10 cents on less than $100 stocks, and move the decimal 3 ticks to the left. And that determines what our option montage should be reflecting our between the bid and the ask. All right, that's a green light. Then basically 50 cents would be your yellow light. It needs to be kind of between 25 cents and 50 cents is a yellow light. All right. Our environment, I see a couple of questions coming up. Our environment here is that we want it to be an IV percent. IV percent. I should switch my pen here. IV percent is less than IV percent of 50. All right. That's where we want to be thinking we're going to be buying it. Our duration is greater than like 60 days to expiration. Days to expiration. All right. And our strike locations, just to review, is between a 35 delta and a 45 delta. All right. Just a little review there. All right. So buy in the money, sell out of the money. No, I shouldn't have even said that. I buy out of the monies on this one. Now, when I'm doing like a long put spread, then that changes a little bit, because then I'm trying to take advantage of some of that delta. And we'll talk about that next week. When I'm doing the long put, I'm just hitting those out of the money. So these are, I'm looking at just out of the money. All right. Because I don't want any intrinsic value right now. I want a quick move. I think it's going to happen right away. I want to take advantage of it right now. And you get more bang for your buck. And I've done some videos on it. Why you pick the out of the money. It ultimately is better to pick these out of the monies if you get that directional move. Yes, those ones that are in the money have a higher delta. So you would think that ultimately that the deltas would work in your favor. But the fact of the matter is it actually, because if I were to think about it as premiums, and I've got so much money to spend, if I could do a 1 lot on those in the monies, I could probably do a 3 lot on those ones that are just out of the money and capture the same amount of premium. It would cost me the same amount. So the 3 times on the ones that are just out of the money are going to ultimately increase in value better. Does that make sense? Because the ones that are in the money, maybe I pick a 75 delta, and now I'm picking an out of the money. I could only afford one of those that is at 75 or 85 delta, and I can pick 3 of these or buy 3 of these options for the same amount of money out of the money at that 35 delta. Well, all of those delta adding up will be better in the long run if I'm directionally right. And we still risk the same amount of money, right? That makes sense for everybody, why I'm picking those out of the monies also, and why it is better than picking it in the money. Because you can really, if you only have a certain amount of money you like to risk, say it's $500 or $1,000 on any given trade, because, it's a percent of your overall portfolio. Well, if I'm willing to risk $1,000 on this directional assumption, if I pick an 84 delta, I can probably only buy a 1 lot. And if I can buy a 35 delta or a 45 delta, and I can buy 3 of them, well, those deltas, it's 3 times 35. So we're talking over $1 increase for every dollar the underlying moves versus 84 cents. Does that make sense? Everybody? Cool. All right. So we do need to know our max profit is the underlying goes to 0. We see Lyft go bankrupt. Probably not likely to happen right now, but it could. It could, absolutely. So if the underlying goes to zero, that's our max profit. I don't usually look at that being my max profit. I'm looking for basically a double on this. All right, I'm looking for my premiums to double for that max profit. Max profit is the premium, or max loss, I'm sorry, is the premium paid. That's the beauty in buying options. Anytime you buy an option, you cannot lose any more than what you paid for it. Because when you're buying options, you guys, you have the right but not the obligation to fulfill that or have that contract fulfilled, right? Which means you're basically saying, take my stock. You know, you get short that stock, right? Whereas if you are the seller of the option, you know, you have to, you're beholden to whatever that buyer says when and at the whimsical of them, you know, whenever they say they want to do the contract. All right, break even point is the long put minus that premium paid. So we have to, if we pay for a premium, we need that market to come down in order to get to our break even. Now, it doesn't mean to be profitable. Like if I get a quick move right away, this is at expiration, you guys, right? If I pay a premium, I have to make up on that premium in order to get to my break even. Well, during the life of this option strategy, it can go down there and never hit my break even point. All right. It may never hit that. If it just comes down and hits my strike, like in the next couple of days or something like that, we're going to probably be at my max or my exit. All right. Or when I think we should exit on it. So that's something that we would be looking at for this strategy. All right. So we're just looking to exit that. So ultimately, what are we looking at for this? If I'm looking at, we need to know what our exit is. So we're going to be looking at the underlying on lift, right? So I have, however you come up with your directional move. Now, you know, an assumption, maybe you think it gets above the 200-day simple moving average, you're out. It breaks this kind of pattern. Maybe goes above here, you know, because you're saying, well, Wolfman, I've got higher highs, higher lows. It's in a kind of a bull trend here, whatever, you know, but you could say I'm out if it breaks above that high there, okay? And I have no problem with that. You can even say when I lose 50% in value of my premiums, I'm out. It's hard to tell you what you get out for a loss because that really is something you have to do some soul searching on. I have a high risk tolerance. So with these, I'm usually more likely to just let it play out and I'm willing to lose that money if I'm wrong on the trade, okay? So, but in this case, because it is kind of trending this way, I would probably look at it like it goes above $42. I'm out of this trade, okay? So we talked about this. I don't want the 29 days to expiration, right? I don't even probably want the 65 days to expiration. I'm going to have to look at it though, because 100 days out is quite a long time. But I'm going to be looking at somewhere between the 45 and 35 delta. I don't like to do the half strikes, so I would probably be looking to buy this one here. All right. So I would be looking to buy there. And like I said, if it went above that strike location here, then I'm going to look to get out. Actually, I'll do this. If we kind of go above here, I'm looking to get out on a loss, right? But my target on this, I believe that we're probably going to come down to at least here and probably somewhere around here and test these lows, okay? So I'm looking for a move down here, so somewhere just below 32. All right, so I want it to go in the money, so I'm going to be a pick 'em between these two. So you can even go over and look at the volume and open interest, and you'll see that most people like to pick the full strikes, and that's just a product of being a trader. So look to buy those 35s. If it goes down and trades the 32, that's where I'm going to get out. Or you know, a 50% increase in my premiums here is usually what I'm looking at, right? So if I go back to here, my exit on a winner, we got lift. We're taking lift, all right? Lift on the 35 puts, all right? The loss, I'm getting out if it goes above 41, and on a winner, if it goes down to 30 is where I'm looking to get out, right? And if it goes down to 30, you guys, I can tell you my premiums are going to have increased at least by that. You know, a home run on this would be, you know, 100% increase. So if I paid $5 and I can get out for 10, that would be huge. That would be a little bit more than it going to this 30 area. But generally speaking, what I'm going to be looking for is a 50% increase in my premium. So if I paid $5, I'm going to be looking to get out at around 7, all right, or $7.50. And I'm going to write all these things down, just kind of like what I did here. I go on a piece of paper and I write that stuff down to make sure that I have all of the data down. Another thing is, especially on this exit, like I would say, you know, I'm paying $5 and, you know, 35 cents or something like that. I'm out. I would write it down. I'm out. I'm exiting. I'm exiting here at $7.50. Okay. Pretty close to that 50% increase there. So, you know, I'm out at $7.50 or, you know, it hits $30. Something along those lines. All right. So on your exit strategy, depending on your risk parameters, you need to do that. But for me, I'm usually looking for that 50% increase in those premiums. I'm also looking at my loss. I usually will kind of ride these out a little bit longer than most people, but you know, for a loss, you can say if it doesn't break this pattern to the upside. All right. All right. Does anybody else have any other questions? Gone a little bit long, I know, I'm sorry. Oh, that's a long question there. Give me a second here. I'm going to pull up the AAL trade just to see, because I think that was something somebody was looking at. And see, for AAL, you know, I could say that the premiums are right in here. If I had a bearish assumption in this, I might look to do something where I kind of isolate some of that volatility, because I don't know if it's going to go, the volatility is going to go up or down in this case, okay? So another strategy might work, you know, maybe a synthetic short or something like that. Eric wasn't kidding. Go see Canyon, Texas show. That's right. Definitely. Is there a hack to approximate the exit strike based upon 50% profit other than watching it or setting an automatic exit when the trade is made? Yes. You know, good question there. So, for instance, let's go back to lift. So lift, what we could do is with looking at these, I need the volume and open interest, the delta. So with this being said, you know, I talked about, I want it to go to 30. That's where I was thinking, right? If it goes to 30 and I'm buying this 35 strike, right? Remember, think back to that delta, right? It's 40 cents for every dollar. Now the second dollar gamma goes into it, and then gamma goes into it again. So it's all, even on the third dollar, you can kind of start ballparking that, okay? It's a little bit off, but it's a good ballpark. So, you know, so that first dollar move down, we get 40 cents. The second dollar move down, we get 43 cents. The next dollar, we get 46 cents, all right? So I'm looking at a $5 move. I'm just going to kind of ballpark it, right? I'm looking for a $5 move. I'm going to kind of go with 45 cents as my average. Well, if I got a $5 move down, right, 5 times that 45 cents, that gives me right around $2 and what, 25 cents or something. So in that case, that's about, you know, that's right around that. So I could say that if it went down to that 30 strike, I could expect my premiums to increase by about $2.25. Does that make sense? So yeah, you can kind of figure it out that way. You just kind of go to the middle of that road. Gamma is going to keep adding in there. You can kind of see here, when you look at it from a 35 strike to a 37 strike, that's a 47 delta, right? That's right in and around that gamma being $2, $2.50, right? It does start, leaning a little bit higher, but that's on the low end as well. Does anybody else have any other questions? Cool. All right, here is the offer, you guys. This is instant access to the lab course here that I'm going to throw over here in the, it's not letting me copy that now. Let me pull this up real quick. Actually, let's see. I'm going to throw this over into the chat window for you guys. You guys can take advantage of this. It's over there in the chat window for the entire audience. There you go. You guys hit on that link I just threw in the chat window because, this scroll, I don't want to scroll through all of this. I'll just kind of read over this. You guys get instant access to the option courses. It's over 100 hours. It's well over 100 hours. I would say there's easily 100 webinars in there that you guys can take advantage of from long to short, so you don't have to really watch the really long one. Thank you, Ed Dalton. I appreciate the kind words. Really good stuff. Appreciate that. Also, first 100 members are going to become charter members of my Option Lab program. That gives you guys all kinds of stuff. You guys get access to me. You guys can ask me any other question. I got a guy in Japan that we talked to back and forth. He asked me about some of his option strategies and what I think about those. I can tell you what I would do. I can't necessarily tell you what you would do. And that is, we're starting to fill that up. I think it's getting closer to less than 50 spots available on that. You'll also receive automatic upgrades, VIP option member status. That gets you access to future content and promotions, discounts, all of that great stuff. VIP invitations to lab events, and you get question and answers. All right, and that's what I was talking about with you guys want to reach out to me with a problem. You guys have full access to me. I have a no inbox policy on my email. That means I answer everybody. And as a matter of fact, if your question is going to require me to do a massive paragraph, I would much rather just give you guys a call. We'll set that up and do a Skype or something along those lines, which I do with several of my students as well. And to get a bunch of other stuff that is listed over there in the chat window. So pull that link up and you can go through all of the stuff that you get. And there's all kinds of different webinars on there. And like I said, you might see another long put in there, but I might be talking about doing it for an earnings or an earnings setup or different types of scenarios, building out a portfolio like we just did in this previous one. I mean, I was building out my portfolio going into that coronavirus, right? We were like, the timing on those webinars couldn't have been more perfect, to be honest. I don't like to cherry pick stuff like you'll see other people saying, had you done this strategy, you guys could have made 500%. No, I don't do that, you guys. As a matter of fact, I'm looking at this trade for implementing into my portfolio tomorrow. So the reason why I didn't do it today when I came up with the thesis on it was because I don't want anybody to ever think, oh my God, he's just talking about pumping and dumping this stock. No, I'm doing this. You guys get to it before me tomorrow, then, so be it. Don't do it because I think I'm doing it. Do it because you think the thesis is solid in your eyes as well, and it fits your portfolio. I mean, if you're bullish, lift, and by all means, tell me I'm off my rocker. Don't take advantage of it. or don't implement that strategy. You might very well be right. I will never say I am the end-all be-all of directional assumptions. But what I will tell you is that, you know, I've been doing it for 25 years and made a pretty good living doing it. But that's because I've done these strategies in scenarios and set myself up for success, like buying cheap premium and selling expensive premium. Yeah, a lot of people go out there and say, you should never sell calls and puts and da-da-da-da-da. Well, if you do it with the right, you know, if you're selling puts with a full expectation of, you know, buying that stock, then that's not a bad thing, to be quite honest. And if you sell calls against your underlying, that you know, you lower your overall cost basis. That's really the way to get ahead in this game, is playing around with options. And yes, sometimes I talk about selling options, and I'm not afraid to say it. I'd much rather be selling options. The probabilities are much better in my favor when you're selling option premium, to be quite honest. And it's quote unquote more risky. Well, if the probabilities of my success are 85% versus 50-50, I don't know, what's more risky, a 50-50 flip or an 84% probability in my favor? I lean towards 84% probability in my favor. All right, so that link, like I said, is over there in the chat window. Take advantage of that, especially if you guys have enjoyed this, if it makes sense to you. My whole thing with these, the reason why I took an hour and 15 minutes on this, hour and 15 minutes on this, is because I try to get those little nuances, get your brain, you know, figuring this out, so it makes sense, right? You know, if you go online, they're just going to say, go buy a put. All right. I mean, I could have been done in 2 minutes. Just go buy a put. All right. No, you can't. You have to think about all this stuff. Why do we not want to buy that in the money put, which some people do? They're going to be like, oh yeah, you get 84 delta, or, you know, that means for every dollar it goes in my direction, I gain 84 cents. That's huge. Well, yeah, but when it goes against you, it's also a lot worse, right? Anyway, that's my soapbox. I'm sticking to it. But you know, ultimately, I just want you guys to have something you can correlate it to and something to grasp onto. All right, thank you guys all for attending this webinar. Later on webinars, I'll drill down on different option components, when and where I find those appropriate. Also, here's the link. Again, if you're watching this on tape delay, you're going to have to type this into your URL. It's not a hot link. But the hot link is over in the chat window. Thank you guys. Also, if you reach out to us at 310-598-6677, if you have any questions about the offer or anything else, and if you have any ideas for future webinars, something else you want us to take into account or do a webinar on, reach out to us at trading@protraderstrategies.com. Finally, the disclaimer. Yes, everybody has to do a disclaimer. Why? Because there's risk, financial risk here. Yes, you could lose money. People, you could lose money. And I'm here to educate you. I'm not here to solicit. I'm not here to tell you guys to go out and buy puts and lift. That is the furthest thing from what I want to do in this. Like, if there is anything you can take away from that, is what I do is not to try to give you guys investment advice, right? I don't believe in that. I don't know what your risk parameters are. I don't know what's in your portfolio. I don't want you to follow my assumption because, like I said, my assumption might be wrong. But I know how to find the right strategy for those assumptions, all right? So, you know, hopefully this will help you when you're going through your process in order to find the right strategy for you, is what I really want. And, you know, we make better markets that way. All right. That's all I got for you guys. Again, go over there, take advantage of that. That's all I got. Other than one last thing. If you can't take that, take it easy. Bye for now, guys.